Welcome guys back to another video. In today's video we're going to be having a look at chapter 4, 5 and 6 for the economic syllabus. So basically chapter 4, 5, 6 is simply the macroeconomics, as you can see here, the macroeconomic segment of economics. So I've made a video on chapter 1, 2 and 3. I'll be linking that video down in the description. So after completing this video I would have now finally finished the entire syllabus, and then we're going to start moving on into past papers and more practice on everything that we've been having a look at. So today's syllabus, or today's outline or topic outline, or today's topics that we're going to be having a look at is chapter 4, 5 and 6. So without further ado, let's begin. Now all these notes will be down in the description, the previous videos down in the description, past papers and all those sort of economics playlists will be down in the description. If you need any other assistance, the comment section will be there, and I'll try to answer all your questions as quick as possible. So without further ado, let's begin with the first topic, where we have a look at the macroeconomic aims of the government. Now macroeconomics, before we even start with this topic, is simply the study of the government. Now previously in chapter 1, 2 and 3 we had a look at microeconomics. We had a look at something called microeconomics. Microeconomics simply is the producers and consumers, so those are the main focus. Okay, the producers and the consumers were the main focus. But now for macroeconomics, it's only the government right here. So in these chapter 4, 5, 6, we'll be having a look at what the government does, to, for example, help with the economy. Or what do they do in terms of taxes? What do they do in terms of the resources allocation? What do they do in terms of employment, poverty? What do they do? What are the actions that they take in order, for the economy to be better and better? Okay, so that's basically what the government aims to do. Okay, and we're going to start with the first topic on what the government wants to do in the economy and why there might be a government. Okay, so let's start from there. Let's just clear this and let's begin with the first one, the aim of the government. Now the public sector in every economy plays a major role as a producer and employer, and the main one, the government. The government basically is a very important role in the economy. They decide what happens next, okay? And that's why it's very important to learn about the aims of the government. So let's begin with the first aim. Now, a government can be either a producer or a consumer. Now, this basically means that a government can act like a producer and they can also act like a consumer. Okay, what do I mean by this? Okay, let's begin. Now, let's have a look at the government in terms of a producer. Okay, in terms of a producer, they will provide merit goods. What are merit goods? Merit goods are simply goods that give a positive effect into the society. Now, we've talked about merit goods when we had a look at, I believe, market failure. So you would understand that term if you have a look at the previous chapters. So, in this chapter, it's moreover like, things that we've already covered, and now we're just going in depth in terms or in the perspective of the government. Okay, so those are merit goods. Merit goods are simply like education, health services, and public transport, everything. Those are called merit goods. They give a positive effect in the society. The next one is the public goods. Public goods are like streetlights. Now, streetlights are something we call free goods, and we've already talked about this in some previous chapters. But a quick recap is a streetlight is a free good because you cannot measure the amount of how much someone uses it. Okay, for example, the street light on a road, if it's right here and so many cars passing through every day, we do not know how much someone uses the street light. Maybe they don't even go to the road and they're not using it, so we cannot charge people for the usage of street lights. Okay, because you cannot measure how much they use it, because people use it at different whatever different uses or stuff like that. Okay, some can be using streetlights more than others, but you cannot charge it, okay, because you cannot measure it. So in that terms, the government comes and intervenes and will therefore provide these streetlights. The next one is welfare services. If citizens are unemployed, it's the right for the government to provide them with the basic facilities, because of course they're a citizen of a country and the government has to do that. Okay, The next one is a public service. Just like the public goods, there's public services like the police stations, the fire stations, and this is usually used to control or manage the economy. So manage the economy. Okay, so manage the economy. They're usually used to control or manage the economy, like police stations, fire stations. All of that is used to manage the economy. The next one is the infrastructure. Infrastructure simply structures like roads, electricity, so on and so forth. That's all provided by the government. So you can see the government in here is doing a lot of work. The government right here is doing a lot. So the government is doing all of this work. We move on to what if the government is an employer in terms of consuming. Okay, they will support agriculture and other prime industries. That means that some parts of their area might be really poor, and the government will have to support their agriculture, support their farm. So they'll have to invest into them to help those people. They will help the vulnerable groups, like people that are disabled, for example. They provide services for them. They help to redistribute income, and later on we'll get to know a lot about income. We'll do an entire topic on income, and you'll understand everything about what the government does within income. Then they have to manage the macroeconomic terms of prices, employment growth, income redistribution. We'll talk about all these topics in just a bit. So this is basically an overall, a look at what the government does. Okay, and the government will also have a look at trades of goods and services with other countries. We call this we say something called the foreign exchange rates. Okay, we'll have a whole topic on this. Basically, when we're having a look at the foreign exchange rates, we're having a look at buying and selling goods from different countries, what's the exchange rate, and everything that is done by the government to ensure there is good economic growth. Okay, later on all these terms right now that I'm talking about, we will have a look at everything in this topic. This is just, as I told you, an overview of what the government does, so you understand why it's important to have a government. Okay, let's move on next to the final terms, or let's have a look at the terms that I was talking about. So the terms here that we have is, number one, the economic growth. We have price stability, we have full employment, balance of payment stability, and income redistribution. So basically what I was just talking about. Now these are, we call, the major economic objectives. Okay, and throughout this chapter we're going to be having a look at these macroeconomic objectives. Okay, so let's start with the first one, the economic growth. So let's start with there. Okay, now an economic growth is simply the gross domestic product per head, the GDP. Okay, the GDP. It's very important to understand the term GDP. GDP is simply the amount of goods and services available for every person in the economy. Okay, that means when we talked about microeconomics, we had a look at how producers would produce goods, and how consumers would consume them. Okay, that was basically what microeconomics was. Microeconomics was. But for macroeconomics, we are having a look at how can I increase this output. Okay, because later on we will know that when we increase this output, okay, we will have something called the economic growth, and that's very beneficial for the government. Not only for the government, but for the country. Okay, so basically the economic growth is increasing output for the goods and services in the economy per person. Okay, now in the economy we know that there is producing, there is consuming. Economic growth basically focuses on how can I increase the number of outputs in the economy. In simple terms, that's all you need to understand. Now, why do we want to increase the output? Here is the reason. Number one, let's have a look at the disadvantages. Okay, if the output is low, what will happen? Okay, the employment, the income, the living standards will fall. Why is that? Okay, now let me just emphasize more on this topic. Now, for example, we are producing just very little output, meaning very little goods. So goods are very little. Okay, That means that not everyone will have the ability to gain these goods, and the price of these goods will be so high because of how limited they are that not everyone can afford it. And when not everyone can afford it, the employment rate will decrease because we have very little goods, so we don't need that many employers. The income will reduce because there will be no work available because of how little the goods are, and the living standard will fall because they don't have the ability to gain these goods. But when an economy has so many goods, okay, that means they will need so many workers to make those goods. Number one, when they have so many workers, that means they will have so much income. When they have more income, they will have enough money to spend on their lifestyle, which will increase their living standard. So it's quite like a chain, and you need to understand why we should have good economic growth. Okay, so that's one reason why we would want economic growth. If the output falls, the tax that per product will reduce. And if tax is a very important revenue for the government, so you need to know that tax is a revenue for the government. Okay, it's a very important form of revenue for the government. But when the goods are less, there will not be enough tax. The next one is that the revenue and profits of the firm will fall, because when there's less goods, there will be less profit. And when there is less profit, people will not want to invest into the business, and therefore there will be very bad economic conditions, because there will be lower and lower profits because no one wants to invest in the business. So that was everything about economic growth. Now, this was just a simple introduction to economic growth. Later on, we will have a look at advantages, disadvantages, characteristics, how we can improve it, how we can not improve it, of course you would want to improve it, but what are the reasons why it does not improve, and so on and so forth. Okay, so that is economic growth for you. Let's have a look at price stability. Now, price stability simply has a look at the average price levels, okay? Average price levels. Now, the governments target a particular inflation. Okay, what is inflation? Now, inflation is simply the continuous rise of average price. That means when a good was first $5, has now increased to $10, from $10 to $15. That's inflation. It's rising and rising and rising, and people aren't able to afford these products. Now, why does something rise? Okay, why does the price rise? Now, one reason for rise in price could be maybe people's income increased, maybe there's limited resources. All that can lead to inflation. Now, the price stability basically focuses on that the government wants to reduce inflation. Okay, because if there's lower prices, people can buy more and more, so the poor people can buy more and more. Okay, and therefore they'll have a nice lifestyle, their living standards will increase. But when it's so high, like $15, a poor person isn't able to actually afford this. Okay, so the government tries to make this good $5, okay, to make it cheaper and cheaper. And that's their aim, so that everyone can have a good lifestyle. Not only a good lifestyle, but the poor people can afford stuff. So therefore, it will cause hardships for the poor. If there's a negative effect, if the prices rise too quick, then there'll be hardships. If the prices rise too much, then the workers will need more wages. The workers will demand for more wages because they need to support their lifestyle. Because since everything is expensive, they will tell their manager, increase my salary because I cannot buy the basic necessities. So the business cost will increase. The next one is that the products will be more expensive than the products of other countries with low inflation, and this basically means the exports will be less competitive. Basically, exports are stuff that are made within the economy and we're selling it to other people. So we're exporting it from our country. But because there's high prices in our own country, why would someone want to buy from our country if it's so expensive? Okay, so the exports will be less competitive. We now move on to full employment. Okay, now this is a general aim and everyone should know this aim. Okay, the economy needs to be employed, because if there's more employment rate, then people will have a higher income. If people have higher income, they will start to buy more goods and services. If they buy more goods and services, the tax will have increased. And if tax is increased, what happens? The government revenue increases, so the government can spend in different stuff. So we need employment. Employment is really important. Okay, but if there's a high level of unemployment, then the output will fall, because remember, workers are not there, and then they'll have to pay so much unemployment benefits, which we call this term the deficit, a government deficit. We call this a government deficit, okay, because the government is paying so much money and getting nothing in return. We say this is a government deficit. Okay, we move on to the next one. The next one is the balance of payment stability. Okay, in simple terms, in simple terms, a country would import and export. Okay, the balance of payment stability basically means the amount of imports should equal to the amount of exports. They should be balanced. Okay, that's the main aim, and that's all you need to know. Okay, that's what balance of stability means. Okay, so economies would sell their products to other people overseas and would buy from other people. So that's what we call imports and exports. But here's where the problem comes. When the exports, as you can see right here, when the exports are greater than the imports, we have something called the surplus in BOP. Okay, but when the exports is less than the imports, we have a deficit. And all economies will try to balance the exports and the imports so that they can avoid the foreign currency, out of foreign currency. Here we can come across the term foreign currency. Okay, and the value of its currency will fall against other foreign currencies, which will make imports more expensive to buy. Okay, because our currency will be so low, we can't afford anything in other countries. Okay, so that's the reason why we need to have, the correct inflow and outflow into the country. The next one we say is the income redistribution. Again, these are all macroeconomic aims. Income redistribution is self-explanatory. The poor people should have enough income so that they can satisfy, or they can acquire the basic necessities. And the rich people should be given a tax so that the government can, get some revenue from there. So it's as easy as that. And we do this so that, we can have income equality. But there's always income inequality, and this is because the widening inequality means higher level of poverty. When there's a big gap between the rich and the poor, that means there's a high level of poverty. And if there's poverty, then the people will struggle. They can't buy the basic necessities, and that will result to a bad economy. So the government will aim to make the inequality, they basically make it narrow. They want the poor and rich to have a smaller gap in between, so that poverty cannot be that big of a difference in the economy. Okay, so now we have a look at the conflict. Okay, because when our government tries to do one aim, they will spoil another aim. Okay, and that's where we come to the conflicts of a macroeconomic aim. So it's very important for the government to decide which aim they should target most compared to the other one. And the first one is full employment versus price stability. Full employment is, remember, when you employ the workers, and price stability is when we come back and we check it. Price stability is simply to avoid inflation. Okay, now low rates of unemployment, low rates of unemployment, meaning more employment, will boost income. Okay, that means people will have more income. When there is a rise in income, the demand will increase. And remember when I told you, why does the price rise? The price rises because when there's more demand. Because the producers know when there's more demand, they will get more profit, so they increase the price. When they increase the price, inflation occurs, and therefore that's one conflict between the macroeconomic aim. If you don't understand that, you can always pause the video, just read this sort of text right here. You can read it, or you can just understand it by what I am saying. Okay, we move on. The economic growth and full employment versus the BOP stability. So we have three here. Economic growth is increasing output. Employment is increasing the workers. BOP stability is simply the inflow and outflow of the goods coming in the country. Now let's have a look at this. Once again, if the income rises because there's economic growth, because when we have more output, we have more workers, then people will start to import other products from different countries. Okay, now for example, let's give a good example of cars. Okay, in your country there may be not one supercar, okay, for example, and in other countries there are. So if you want a supercar in your country, you'll have to import from another country. Okay, and therefore there will be so many imports because people have the ability to, that there will be, we call the deficit in BOP. Okay, we call it the deficit in BOP because the exports are less. Okay, so you can see there will be a there will be a deficit. As you can see here, deficit may arise. Okay, the last one is the economic growth versus the full employment. Now, economic growth is, again, I keep reminding you these terms because we will be referring to these terms again and again. That's why I'm repeating the meanings of each of them so that it sticks into your head. Economic growth is increasing output. Full employment is having more workers and more, okay? When the economic growth increases, people will start investing in more machinery because there's more profit, okay, when there's more output. So when they invest in more machinery, then the capital intensive production will be more favored. And we've talked about this term, capital intensive production, in the previous topics in chapter 1, 2, and 3. Basically, capital intensive production is when there's more use of capital like machinery compared to labor, okay, which is, for example, workers. So this would reduce employment. So this is simply the conflicts of the government aims. So there you go, that's the first topic, and now we're going to be moving on to the next topic. So now let's talk about the fiscal policy. Okay, the fiscal policy is just one of the policy that the government does so that they can basically achieve their aims in the previous aims that we're having a look at. So their fiscal policy is just simply something that they do so that they can achieve those aims that we had a look at in just a bit. Okay, so fiscal policy, let's start by defining what a budget is, okay, because a budget for a government is really important. Okay, now a budget is simply the financial statement showing the forecasted revenue and expenditure. So revenue is what they gain, what the government gains, and expenditure is what they spend. So the budget simply talks about what the government expects to receive as revenue and where they will use this revenue to spend the different stuff they want to do to achieve their aims. Okay, that's what we call the budget. So the fiscal policy is simply we have to look at what a budget is in order to understand fiscal policy. When we're having a look at fiscal policy, the main aim we're looking at is government spending. Okay, and right here you can see government spending. Okay, in order to do fiscal policy, the government has to spend to achieve these aims that we had a look at previously, like economic growth, full employment, price stability, income redistribution, so on and so forth. So here we come and talk about the fiscal policy. Let's start, before talking more about fiscal policy and what fiscal policy is, let's start by talking about why the government spends and what the government spends in. Okay, now first of all, a government would spend on stuff we talked about previously. Okay, when we had a look at the role of the government in the first topic, we said that the government can act as a producer and can act as a consumer, like providing public services, like providing merit goods. For providing this stuff, you need something called money, okay, and that's where the government has to spend. Okay, to provide these roles, they need to spend. So why does a government spend? Let's begin with that. The first one is to supply goods and services that the private sector would fail to, and this would be the public goods. Now, again, I told you previously that the producers do not produce everything. They only produce goods that are profitable, okay? So they would avoid those goods that don't give them a lot of profit. And that's where the government comes into. The government intervenes into this, okay, like making roads, street lights, and providing merit goods like hospitals and schools, and finally providing the unemployed some welfare benefits, because again, they're part of your country and they have the right to get those basic necessities, so the government has to spend on them just to give them the welfare payments and benefits. The next one is the supply side improvements. Okay, there's something called the supply side policy that we'll have a look at in just a bit, but that is the supply side improvements, and basically what that means is that they can increase the labor productivity. Okay, they will, for example, spend on education so they can improve the productivity. Now, the government would spend on this so that they can increase the output, and remember, if they increase the output, there is economic growth. Okay, and economic growth is an aim of the government, so they would achieve supply side improvements. The next one is negative externalities. We had a look at this in chapter 1 to 3 when we had a look at market failure. Negative externalities are simply like pollution, or something. When the producer produces something, there can be negative externalities, and it's the government's aim to reduce this. The next one is to subsidize industries. A subsidy is simply a financial grant that is given to the business so that you can have a lower cost of production and promote the good they're selling. Okay, maybe if it's agriculture, for example, and you need, want to promote agriculture, the government would provide subsidies to this industry so that they can be more vegetables, for example, in the economy, which is a merit good, okay, because it's a healthy food and they want to promote healthy food in the economy. The next one is to redistribute income. The government really struggles with this. Actually, every country struggles with this. They want to have a low poverty rate so that everyone can, have a good lifestyle. And the last one is to aid economic growth. Is to aid economic growth. Now, let's have a look at the effects of government spending. Okay. Now let's have a look at if the government spends, what happens. Okay. Now, when there is an increased government spending, this will lead to higher demand in the economy and thus will aid the economic growth. When the government will spend, there will be more demand because, for example, they subsidize something. Okay, let's talk about maybe if they provide merit goods. Okay, that means there will be higher demand for that product, and therefore it will mean that producers will provide more output of that good, and that will be an economic growth. But this can also lead to inflation, because remember I told you, when there's more demand, more demand will result to inflation. Okay, more demand will lead to inflation because producers know that they have the ability to pay for the goods, so they will increase the price, and that will lead to inflation. Now, increased government spending on public goods and merit goods, would also be would increase the productivity and the growth. So when I give more merit goods, more public goods, then the productivity will increase because, for example, if you have good roads, people can go to work more easily without any, struggle. Okay, that will increase the productivity. Increasing government spending on the welfare schemes will also help the living standards and will reduce inequality, because when the government is spending on poor people, then the inequality gap, or the gap between the rich and poor, will reduce. Okay, but it says here, however, too much government spending will lead to something we call crowding out. That basically means that private investments will reduce if the increase in government is there. Okay, and if they stop investments, then the producers will not be able to produce as much, and therefore the tax will reduce because, again, the output is reduced, and therefore the government will not have enough income to do all this government spending. So that's what we call crowding out. Okay, when you rely too much on the government. Okay, so that was that, and now we're going to be having a look at tax. Okay, so now we look at tax. So tax is a very, very important form of revenue for the government. Okay, now tax is one of the main revenue for the government. Okay, Now we're going to be talking about tax, the advantages, disadvantages, the types of tax, and everything related to tax. Now governments can earn revenue through the interest on government bonds and loans and penalties and stuff like that, grants and aid and stuff. But tax is the main revenue for the government. Okay, now there's other forms of revenue for the government, like we just mentioned, like loans and when someone does a crime, the penalties they have to pay. Those are all revenue for the government. But the main revenue is tax. Okay, and the major source of revenue comes from taxation. Taxation is simply a compulsory payment that is made to the government by all people. Okay, that's the keyword right here. Okay, by all people. Okay, in the economy. There are many reasons for leaving tax from the economy. So what is the reasons for tax? Let's begin. Number one, a source of government revenue. That's the main one. So we start with that. Now, if the government has to spend on public goods and services, it needs the money, as I previously said. And there, they get it from taxes. So taxes gives revenue, and then revenue can help them or give them the ability to provide those public services that they need to do for their aims. Okay, so the money that is got from tax is used into the aims that they want to do. The next one is to redistribute income. Okay, once when the governments levy taxes from those who earn higher income, have a lot of wealth, they will then use those funds to basically give schemes for the poor. So the rich people will basically give them money so that they can provide schemes for the poor. The next one is to reduce consumption and production for demerit goods. For example, if you've noticed, alcohol will have such a high tax because they want to, discourage the consumption of these goods. We call this the excise duty. Excise duty is simply when you provide a tax onto demerit goods. The next one is to protect home industries. When you want to protect home industries, taxes are levied on foreign goods so that they can control what we talked about, the BOP, the balance of price stability, so that the inflow and outflow is, sort of controlled. They have to give a certain tax to each of the goods. That's why, when you import something, the price of the tax is very expensive because they want to avoid the BOP. This we call the customs duty. So we had a look at the excise duty and the customs duty. It's a type of tax, okay? And we'll have a look at the indirect taxes, and in indirect taxes, we'll have a look at this. To manage the economy, we'll also have a look at that. So basically, you need taxes that you can, get the money so that they can manage the economy. For example, you can use taxes to increase the demand. So when the taxes are low, you can increase the demand. Okay, and maybe when they increase the demand, there can be more output. But again, there are consequences, because remember, if there is an increase in demand, there is an increase in inflation, which is very bad for the economy. But basically, that's just an example to manage the economy. Let's have a look at the classification of taxes. Okay, there are two types of taxes. We have the direct tax and we have the indirect tax. Okay, let's start with the direct tax. So let's have a look at direct tax. Direct tax is simply tax on income. As simple as that, tax on income. Now, people will of course earn income, and from that income, the government takes a percentage from that income, okay? And that's what we call the direct taxes. Now, indirect taxes, we have two types of direct taxes. We have the normal one, the income tax, and we have the corporation tax. The income tax is for the person. Okay, an individual person. But for the corporation tax, it's for a business or a firm. Okay, it's for a firm or a business. Now, the income tax is for the individual's income, and it takes a percentage from the individual's income. And there's many things that can happen when that happens. For example, their income will now reduce, and maybe if the tax is so much, people will not even bother working, because they will say that I'm working this hard and they're taking this much tax. What's the point of, working? But then when the government will lower these direct tax, then people will start working more, so the employment will increase. If employment increases, the output increases, economic growth. Okay, then we have the corporation tax. The corporation tax is for the company's profit. So whenever the company makes a profit, you have to give a certain tax to the government. Okay, so that is all that. And then we have the capital gains tax, which is simply tax on property. So whenever your property increases the value, you have to also give tax. And then there's inheritance tax, which is basically tax on inherited wealth. So when someone passes away in your family, the wealth is given to you, but at the same time you have to pay that tax to the government. Let's have a look at the advantages of the direct taxes. The first one is high revenue. Okay, when everyone or most people, persons' income, all persons' income will give tax. Okay, more tax will equal to more revenue. Okay, so therefore the tax is very high, meaning the revenue will be a lot. Okay, this can also reduce inequalities because, for example, the poor people might not have enough a lot of income, so the tax will be or the revenue they get from that tax will be less compared to someone that is very rich. So that's just one example. Okay, let's have a look at the disadvantages. So there are only two advantages for the direct taxes. With the disadvantages, we are having a look at there will be reduced work incentive. I talked about this. Basically, what this basically means is that when there's a lot of tax onto the income, people will not want to work because of how much the government is taking. They will say, okay, there's no point of working because they're taking so much tax. So therefore, they will reduce the work incentives of people. The next one is that it will reduce the enterprise incentives. That basically means that if the corporation tax on a business is so high, they will not want to make profit, and so people will not only start businesses, instead they will start looking for some other work. The next one is tax evasion. Tax evasion is simply when people find legal loopholes. Okay, basically when someone pays by cash, there's no tax. Okay, because you can take that cash and put it into your pockets, because so many shoppers or shopkeepers would say pay by cash, and they will give you a discount because there's no tax. Okay, so that's the reason why people prefer to pay by cash. The next one is indirect taxes. Indirect taxes is taxes on goods and services. That's the key word right here. Goods and service. Goods and services. There you go. Goods and services. It's basically taxes on goods and services, and it is added to the prices of goods and services, and it is paid while purchasing the good or services. When you purchase something, you get a tax. Now for this, tax is the same for everyone. So when you buy bread, it's the same for everyone. Okay, so we have three types of these examples. We have the first one, the GST and the VAT. Okay, this would include the price of goods and services on that good. Okay, there's tax on that good. The next one is the customs duty. We had a look at this. This is of demerit goods. This is for the customs. This is for imports and outputs. Imports and exports. So this is for inputs and exports. And then we have the excise duty, which is for the demerit goods, which are basically harmful to the society. So the government will provide tax on it so that you can discourage the consumption of them. What are the advantages of this tax? The first one is cost effective. There's no extra money that you need to do. You just have to give it to the you can fix a certain rate for that particular good, and that's all you need to do. You don't have to spend anything to acquire these taxes. The next one is that it is expanded the tax base. That means everyone pays the tax. Therefore, there will be either you're young, you're old, unemployed, you have to consume these services, therefore you have to pay this tax. Okay, and then you can achieve specific aims. For example, if you increase the excise duty, then it will discourage the consumption of these goods. So you can control these taxes. The next one is that it's flexible. So when we're talking about flexible, you can say that indirect tax rates are easier to change than direct tax rates. Okay, therefore it's more effective. Okay, so it's flexible compared to direct tax rates, because every income is different, and hence you have to do a lot of complications or a lot of procedures in order to change it. With the disadvantages, we have inflation. Okay, when the prices of products will increase, the indirect taxes are added on it. Okay, meaning that the price of the entire good is so high, inflation can occur. Now we have regressive tax. It's regressive, meaning that some people, since all people have the same amount of money, irrespective of their income, the tax will fall heavily on the poor because it's the same. And if you have a lower income and you buy bread, for example, the tax is so high for bread that, for you, there's a lot of hardship. For you, you won't be able to afford it because when you're poor, you don't have enough income. The next one is tax evasion. The tax evasion simply is high tariffs on imported goods or excise duty on demerit goods. So this will encourage illegal smuggling. Now let's have a look at the types of taxes other than, the indirect and direct. We have the progressive and the regressive. The progressive tax looks at taxes that have a burden on the rich more than the poor. That means if you have a higher income, you pay higher tax. So that means the poor people have lower income, so they pay lower tax, right? But when you're rich, you have to pay more tax, okay? That means it's progressive. There's more burden on the rich. The opposite is regressive. Regressive is when the poor people have to pay a lot of tax in terms of how much income they have compared to the rich people. And they usually say the rich become richer and the poor become poorer, okay? So that is that. And then we have the proportional tax, which is usually, the more favored one, because these taxes will burden the poor and rich equally at the rate of taxation remains equal as income rise or fall. So it's a fixed rate. So with a proportional tax, it's a fixed rate. There's a fixed rate. Okay, so that is that. Now, let's have a look at the qualities of a good tax system. Okay, and then so qualities of a good tax system. Number one, they should be equity. Equity is simply that the tax rate should be, something that should be sensible. Okay, the tax rate can't be so much that it's, more than even the cost of the good. Okay, it has to be justifiable and based on the ability of the taxpayer. The next one is the certainty, the amount of tax to be paid, when to pay it, and how to pay it. There should be, sort of information for all of this on when they pay it, so people can be ready in advance. The economy, okay, then is the cost of collecting the tax must be minimum and shouldn't exceed the tax revenue itself. That means that if you're collecting so much cost of the tax, it shouldn't, exceed the tax revenue itself. You can't have that much tax revenue and you're not even, sort of using it, for example. Okay, then it should be convenient, because you can't, have long procedures of paying the tax. It should be convenient. Okay, when you're buying the good, it should automatically deduct. You don't have to do any separate procedures. Then we have elasticity. Elasticity is simply that, for example, we want to make a change in the economy. It should be easy to change the tax rates accordingly. So, it doesn't challenge someone's income when you make a small change. So it should be elastic. Then it should be simple. It should be a simple tax system. This is a very important point. It should be simple, okay? Because, it should be able to understand by everyone. It should be a simple tax system so that collectors and payers understand it well. Okay, we'll move on now to the impacts of taxation. Let's start from there. So now taxes can have various direct impacts on the consumers, producers, governments, and thus the entire economy. Okay, so with those, things that we just talked about, the qualities of good taxation, the different types of taxes, the advantages and disadvantages, there can be a big impact on taxation. Now, first of all, the main purpose of why, the government would introduce a tax is so that they can have more income. And if they have more income, they can help on spending, for example, healthcare and education and different public services and stuff like that. So, the start when we had a look at the roles and stuff, basically, the government can have a look at all of that, okay? And the impact depends on what the government spends the money on. For example, it may be necessary for the public sector investment, or it could be used for the government's debt repayment. For example, if you took a loan from another country, it can help to repay that debt. Now, consumers will have a less disposable income when you charge tax, because remember, for example, if someone's income was $100,000 and I'm taking a tax, a big amount of tax, maybe to $75,000. Remember, $15,000 of tax revenue, but remember the disposable income is less. Now, disposable income is the income that we remain when we remove tax. That's what we call disposable income. Okay, so the disposable income will be less, and when the disposable income will be less, there will be less expenditure, consumer expenditure, and hence maybe the indirect tax can be less. Okay, for example, so in a way you can get more tax, but at the same time when you're buying goods and services, the tax will be low, so it's almost, it doesn't affect the economy. Okay, the next one is the higher income tax reduces the disposable income, and this will reduce the incentive to work, because when you take so much tax, people will be like, we don't want to work because they're taking so much tax. And when there's that, then there will be less employment. When there's less employment, then there will be economic recession, which is the opposite of economic growth, meaning the output will fall. So basically just two conflicts will affect just because of higher tax. Then we have the substitution effect. When there is higher tax, there will be what? Lower wages, remember? And therefore the work will become relatively less attractive. Then leisure workers will prefer to work less. Some people work because they like to, but then now if there's so much burden, they will feel like there's no point of working, because there's no point. Okay, there's such low wages, there's no point of working. The next one is the income effect. The income effect basically means that when there's higher tax, okay, there will be lower wages. When there's lower wages, the worker will feel like not working for long hours, and hence the productivity will fall. Productivity of someone will fall, meaning they will just work for the sake of it, but not with their full maximum productivity capacity. So therefore maybe their quality of the goods will reduce, and there can be a big impact on the society. The next one you can say is that the impact of tax then depends on which effect is greater. If the substitution effect is greater, then people will work less. But if the income effect is greater, then people will work more. Okay? So basically the substitution effect is when people work less. Income effect is when they work more, because maybe they have to work more because they need that money. Okay? Now, you can't just decide, I don't work, because again, you have to buy those basic necessities. So, therefore people will have to work for such long hours, and they need to work more, so for the more money. But they can be either the substitution effect or the income effect. That one just depends on the economy. Okay, it depends on each. The substitution effect is when the workers will just not work. Okay, and income effect is when they work more. The next one is that the producers will have a less incentive to produce if the corporate taxes are too high, okay? And the private firms will aim on making profits, and if a major chunk of the profits are eaten by taxes, there's literally no point of, starting up a business, because the profits are taken by so much that there's no point, okay? So there will be a less incentive to produce, that people will stop making even businesses and firms. So, having that being said, having talked about taxes, the advantages, disadvantages, the types of taxes, and budgets, and literally everything about that, we come to the main point: fiscal policy. The fiscal policy is a government policy which adjusts the government spending and taxation to influence the economy. So the government will spend and use tax in order to satisfy their aims, in order to achieve their aims. That's a better word there. It's a budgetary policy because it manages the government expenditure and revenue, and government aim for a balanced budget and tries to achieve it using fiscal policy. Now the budget can be either a surplus or a deficit. And basically a surplus means is when they have more money, more revenue compared to the expenditure, and the opposite for a deficit. So basically that's the budget deficit and the budget surplus. Now let's have a look at the budget deficit. What happens when there's a budget deficit? When there's a budget deficit, let's start with a budget surplus. Whenever there's a budget surplus, the government will have more income, okay? We say this is called the expansionary fiscal policy because the government spending will increase and the tax will be reduced. Okay, so whenever this happens, whenever there's a budget surplus in the economy, the government has more revenue. So when they have more revenue, they will start to spend more. Okay, they will start to spend more. So the spending for the government will increase. Spending increases. Okay, and they reduce tax because they don't need enough tax. But when there's a budget deficit, we say there's a contractionary fiscal policy, meaning they don't have enough revenue. They've been spending so much, they don't even have that much revenue in return. So they will reduce the government spending, okay? And the tax will be increased so they can increase the revenue. So the government basically aims to, be in the middle or to have a balanced, budget, okay? That's why we talked about budget as number one, because a budget for the government is very, very important. Okay, because you can help with achieving these goals with either a budget surplus or a budget deficit. So the government will react according to what they have, okay, according to the budget. Okay, so that is the entire fiscal policy. To just basically wrap up what fiscal policy is, fiscal policy deals with the government spending and the use of taxation to achieve the macroeconomic aims that we had a look at. So that is basically the fiscal policy. We will now have a look at the monetary. Okay, so let's now finally have a look at monetary policy. This is the second policy that we're going to have a look at. Then we're going to also have a look at supply side policy. And then finally, we'll have a look at economic growth, employment and unemployment, inflation and deflation. And that is chapter 4. So let's have a look at monetary policy now. So monetary policy is simply a policy that uses interest rates and foreign exchange rates. So with the supply side policy, remember we had a look at the government spending and taxation. But for the monetary policy, we're having a look at interest rates and foreign exchange rates. Just like the supply side policy, we have two types of monetary policies, the expansionary monetary policy and the contractionary monetary policy. So let's have a look at the expansionary monetary policy. Now, the expansionary monetary policy is when the government will increase the money supply and will reduce the interest, and this will therefore lead to a decrease in the exchange rate of domestic currency. Okay, so what is the effect of this? Now, when there's more money in the supply, when there's more money supply in the economy for within the government, producers and consumers, there will be more economic activity. Okay, there will be more expenditure, for example, be more producing, more consuming. When there's lower interest rates, they will mean people can borrow more. Okay, when they borrow more, then they will start to spend more. Okay, when they spend more, the businesses will have a higher profit margin. When they have more profit, then there will be more investments. Okay, and this is all a big chain that you need to understand in economics. Now, everything in economics is like a chain that you need to understand. Okay, now the economic growth and an improvement in the balance of payments will be experienced and the employment will rise. Because remember, when output increases, you need more workers, and so employment increases. Okay, when there's more investment, producers can start hiring more workers, and therefore employment can rise. So that's one advantage of the expansionary monetary policy. The next one, when having a look at the contractionary monetary policy, it's the opposite of expansionary. When there's a decrease in money supply, there will be an increase in interest rates, which will cause the exchange rates to increase. Okay, so there is a decrease in money supply, increase in interest rates, and this will lead to an increase in the exchange rates of domestic currency. Okay, now what is the effect of this? When there's low money supply, there will be less economic activity. And when there's higher interest rates, people will start saving more instead of spending. Okay, therefore the investments will be lower. Okay, and therefore this can help maybe slow down economic growth and can reduce inflation. For example, if there's so much demand because of a certain product, when I introduce the contractionary monetary policy, people will start saving all their money and therefore will reduce inflation because the demand will fall. Okay, but then again, there's a cost of possible unemployment resulting because demand reduces and the output falls, which will therefore mean that you don't need enough workers. Okay, so that's one reason, right? Now, the money supply is the total value of money available in the economy at a particular time. Okay, so because I'm referring to money supply so many times, it's important to understand what this is. Now, the government can control the money supply and interest rates through a variety of tools, like buying and selling the government bonds and reserve requirements. But again, you do not need to know a lot about this in the syllabus. Okay, now let's have a look at the interest rate with the relationship of borrowing. Now, when a person borrows from the money, they have to when the person borrows money from the bank, they have to pay an interest. Okay, so they have to pay an interest. Now, this interest is simply done so that the bank can make some profit. It's a business. A bank is a type of business. Okay, so when their interest rates are high, okay, you will have to pay more in return to what you borrow. So therefore, the borrowing rate will fall. Okay, so you can see here, higher interest rates will discourage borrowing, and therefore investments will also fall. Okay, and the lower interest rates is the opposite. They will be encouraging borrowing, meaning investments. Okay, encourage borrowing and investments. Now let's have a look at this. Okay, the monetary authority of the country cannot directly change the general interest rate in the economy. Instead, it changes the rates of lending between the central bank and the commercial. So you can't just simply change the interest rate. Instead, you can change the rate of the lending between the central bank and the commercial bank, because remember, the commercial bank is run by the government. Okay, it's sort of it's run by the country actually, and we've talked about this in the previous chapters. So for example, if the commercial bank gives less money to the central bank will automatically increase the interest rates, okay, because they don't have enough money and they need money from the consumers. Okay, and something that you quickly need to know is an exchange rate is the rate at which one currency is exchanged for a different currency. Okay, so for example, in my country it's £1, in another country it can be 1.2 pounds. Okay, or a different currency or different stuff. Okay, so that's what we call the exchange rate. So that's all in monetary policy, and that's all you need to know about monetary policy. So monetary policy is quite a smaller topic, and to recap, monetary policy basically uses interest rates and foreign exchange rates in order to get those macroeconomic objectives, to achieve those macroeconomic objectives. Now let's move on to the supply side policy. So let's have a look at the supply side policy now. So basically the supply side policy basically focuses on increasing supply and the productivity in the economy using, as you can see, the macroeconomic aims. Okay, so in this type of policy, the third policy, you just need to memorize what they do. Okay, because in the discuss questions they can say anything related to supply side policy, you just have to state all these points and you would get your marks. So in this type of policy, you just need to memorize all they do. So let's start with the first one. Okay, so the first one is the public sector investments. Okay, that basically means that investments in infrastructure like transport and communication will help the resources. So the flow of resources will be easy. Okay, will be easy, and so the productivity will increase. Okay, will increase. The productivity will increase. Now, improving educational and vocational training. Now, this basically means that when I improve the education, then the training will improve, and if the training improves, they will have enough skills. They will gain skills, and so employment rises. Okay, and therefore productivity rises. The next one is the spending on health. Okay, these are all more just direct, you just need to memorize them. Spending on health basically means when it's more affordable and good healthy, when people are in a good state, then more productive, right? Good state, then more productive. If they're more healthy, then they'll be more productive. Then the fourth one is that their investment in housing. When there's a good lifestyle of a person, then the population will increase. Hence, there will be more available workers, and hence they will increase the output. Then the next one is something we call privatization. Privatization simply means that it will increase the efficiency and increase the output as the private sector has a profit motive absent in the public sector. Okay, so because people want to make profits, okay, there's a reward, people will be more productive. Okay, the next one, number 6, is income tax cuts. When the income tax cuts is less, then people will be more willing to. We've had a look at this, okay, in the previous times. Subsidies is simply a financial grant that is given to the industry, so that will reduce cost of production, which will mean there will be maybe more investments and therefore maybe more productivity. Then we have something called the deregulation. The deregulation simply means that when I remove like complicated laws and stuff like that, and then there will be more output because it's more easy to set up a business, for example, hence encouraging investments. Then number 9, we are having a look at trade barriers. Trade barriers is basically the import, the excise duties and stuff like that. So if there's more imports and exports, the businesses will acquire more resources so easily that they can have more output. So the output will increase. Okay, so in all of this you can see the output will increase. Okay, and lastly, number 10 is that the labor market reforms. Okay, when you make laws that would reduce the trade union powers, and we've had a look at trade union powers in the previous topics, then the minimum wages, for example, could be reduced, and that may create more jobs because it's more cheaper to buy these workers, so therefore there'll be more jobs, so therefore more employment, more productivity, and hence more output. Okay, so this would create more output, this would create more productivity, this would create more employment. So you can see there's so many benefits with this. Okay, so this is what the supply side policy does. Okay, now it says here that supply side policies have a direct effect on increasing economic growth. As I told you, it's directly having a look at economic growth, because economic growth, remember, has a look at output. When the output rises, right? When the output rises, okay, that's why when the output rises, we have more employment, right? More employment because we need more workers to make those products. When there's more employment, there's more productivity. Okay, and hence that is the supply side policy. That's the aim of this entire thing. Okay, so you can see the chain. Okay, and this therefore will improve the balance of payments too. Okay, so there you go, that is supply side policy. Now let's have a look at economic growth. Now not that, now let's have a look at it in more in a detailed perspective. So let's have a look